Balloon loans and adjustable rate loans in commercial context. Many commercial real estate loans are structured as balloon loans. A typical balloon loan might have a 3, 5, 7, 10, or 15-year term, with payments calculated, amortized, as if the loan would run 20 or 25 years. At the end of the shorter term, the remaining principal balance is due in full. The borrower must either refinance or sell the property to pay off the balloon. Balloon loans often have interest rates tied to a treasury index and can fit an investment strategy that anticipates a sale or refinance within a planned holding period. However, refinancing risk is real if market conditions change or the property does not perform as expected. Replacing the loan can be costly or difficult. Adjustable rate loans offer another structure. An adjustable rate loan usually fully amortizes with no balloon, but the interest rate adjusts periodically based on an index plus a margin. Common indices include various U.S. Treasury rates. Some adjustable loans are fixed for an initial period, such as 5 years, and then adjust annually. For example, a 5/1 adjustable loan is fixed for 5 years and then adjusts each year afterward using a 1-year index. Adjustables can offer lower initial rates, but expose the borrower to future rate increases. Types of commercial real estate properties. Commercial real estate encompasses any building, structure, or land used to generate income. Lenders often treat properties differently, depending on their type, risk profile, and occupancy. In many lender programs, buildings where the owner's business occupies at least 51% of the space qualify for more favorable terms because the owner is directly invested in the property's success. Apartment buildings with 5 or more units, as well as larger townhome and condominium complexes, are considered commercial properties for financing purposes. Smaller properties with 4 or fewer residential units are usually treated as residential and can be financed with personal home loans. Office buildings range from high-profile downtown towers to suburban professional complexes. Space in urban business districts commands higher rents and prices, but may also be more volatile and expensive to finance. Retail properties include standalone shops, strip centers with several small businesses, and perhaps one larger anchor store, and large regional malls with multiple anchors. Medical facilities form their own category and include hospitals, surgery centers, doctors' offices, urgent care clinics, and long-term care facilities, each with unique regulatory and business risks. Warehouses and industrial facilities are usually located in accessible locations for trucks and freight and are used for manufacturing, light assembly, storage, or logistics. Hotels and resorts span everything from limited service motels to full-service luxury resorts and casinos. They are among the most complex and heavily regulated asset classes and are rarely suitable for beginners. Land development involves transforming raw land into a permitted and platted site ready for construction. When successful, it can generate significant returns from relatively modest upfront costs, but it carries entitlement risk and requires knowledge of zoning and local regulations. SBA loans and government-supported business financing. Many small business owners encounter the term SBA loan when they seek funding to buy or expand real estate or business operations. An SBA loan is not a loan directly from the Small Business Administration. Instead, it is a loan from a bank or other approved lender that is partially guaranteed by the SBA. That partial guarantee, which can cover a substantial portion of the loan amount, reduces the lender's risk. If the borrower defaults, the SBA pays the lender up to the guaranteed portion, limiting the lender's loss. Because of this guarantee, banks are often more willing to lend to small businesses at reasonable rates and longer terms than they might otherwise. SBA loans frequently offer some of the best combinations of high loan amounts, long repayment periods, and relatively low annual percentage rates available to small businesses. However, they come with thorough underwriting and documentation requirements. Borrowers must provide detailed financial statements, business plans, tax returns, and personal financial information, and the approval process can be slower than some alternative financing options. For qualifying businesses, particularly those buying their own commercial real estate or making significant long-term investments, an SBA loan can be an excellent choice. For others who cannot yet meet the requirements, SBA loans remain a future goal, while more accessible options, such as standard term loans or asset-based loans, fill the gap. Basis points and interest rate changes at closing and beyond. At several points in a transaction, you will hear lenders and investors talk about interest rates moving by a certain number of basis points. A basis point is a very small unit of measure, equal to 1/100th of 1%. In decimal form, it is 0.0001. 1% is equal to 100 basis points. If a lender says the rate increased by 25 basis points, that means the rate rose by 1/4%. This seemingly tiny unit can represent large amounts of money when applied to big loans or portfolios. On a $10 million loan, a change of just 1 basis point changes annual interest by $1,000. A move of 100 basis points, or 1%, changes annual interest by $100,000. To convert basis points to percentage, you divide the basis points by 100. To convert a percentage change to basis points, you multiply by 100. Basis points are used because they reduce ambiguity. Saying that a rate fell by 12 basis points clearly means a drop of 0.12 percentage points, rather than 0.12% of some other quantity. In mortgage and bond markets, where small changes in rates affect large sums, this clarity matters. Debt ratios and debt service coverage in business lending. Earlier in this chapter, you studied income and debt ratios as they apply to individual borrowers seeking residential mortgages. In business and commercial lending, similar concepts appear at the business level. Lenders look at how much debt a company carries compared to its assets, and how comfortably its earnings cover its debt payments. The business debt ratio is calculated by dividing total liabilities by total assets, using values found on the company's balance sheet. If a company has $200,000 in liabilities and $250,000 in assets, its debt ratio is 80%. That means 80% of its assets are financed with debt. A lender may have internal guidelines, such as declining to extend additional credit if the business's debt ratio exceeds a certain threshold. A high debt ratio signals that the business is heavily leveraged and may be more vulnerable to cash flow disruptions. The debt service coverage ratio compares profit or cash flow to the total debt service, which includes principal and interest payments on loans. One common approach is to divide net income, or a cash flow measure, by the total annual debt service. If the result is 1, the business has just enough earnings to cover its loan payments. A ratio greater than 1 indicates a cushion. A ratio less than 1 indicates that earnings are not sufficient to pay all scheduled debts. Many lenders want to see a debt service coverage ratio comfortably above 1, such as 1.2 or 1.25, before approving new financing. These ratios help explain why a bank might deny a business loan even if the company seems busy and popular. High existing debt loads and tight coverage ratios suggest that adding more loans would overextend the business. Yield maintenance, prepayment, and making the lender whole. Some long-term commercial loans include sophisticated prepayment penalties designed to protect the lender's expected yield if the borrower pays off the loan early. One such structure is a yield maintenance prepayment penalty. Yield maintenance aims to place the lender in the same economic position as if the borrower had made all scheduled payments until maturity. In simple terms, if a borrower with a fixed-rate loan decides to refinance or sell before the end of the term, and market interest rates are now lower than the loan's rate, the lender is at risk of reinvesting the prepaid funds at a lower yield. A yield maintenance clause may require the borrower to pay a penalty equal to the present value of the difference between the contracted loan interest and what the lender could earn by reinvesting in a risk-free benchmark, such as a treasury security for the remainder of the term. This can be a very large number if there are many years left and the loan rate is significantly above current market rates. From the borrower's perspective, this means that refinancing early out of a high-rate loan in a low-rate environment can trigger a substantial prepayment penalty. From the lender's perspective, yield maintenance ensures that an early payoff does not create an economic loss. While specific formulas vary among lenders, the spirit is consistent: to make the lender indifferent, in financial terms, between keeping the loan to maturity and receiving an early payoff plus a calculated penalty. Personal guarantees and the funding process. In many small business and commercial real estate loans, particularly when the borrowing entity is a corporation or limited liability company, the lender will require one or more principals to sign a personal guarantee. A personal guarantee is an individual's legal promise to repay credit issued to a business. It gives the creditor a direct legal claim against the individual's personal assets if the business cannot repay the loan. When a personal guarantee is involved, the underwriting process includes not only the business's financial statements and credit profile, but also the individual guarantor's credit history, income, and net worth. The application may require the guarantor's social security number, personal tax returns, and detailed asset information. The lender evaluates both the business and the person standing behind it. Using a personal guarantee can make credit more accessible or improve loan terms, especially when the business itself is young or has limited credit history. However, it also means that failure of the business can lead to personal financial consequences, including exposure of personal bank accounts, vehicles, and even real estate to collection efforts. For this reason, business owners should carefully assess the risks before pledging personal guarantees and should understand that business debt can become personal debt when they sign such agreements. Review summary. In this section, you followed a loan all the way from approval to closing, and then broadened your view into the world of commercial and business financing. You learned that closing a loan involves several perspectives. The lender funds through escrow. The escrow or title company coordinates signatures, disbursements, and recording, and the buyer and seller experience closing as the moment the deed is recorded and ownership transfers. You saw how buyers must bring funds through secure methods, such as wires or cashier's checks, why personal checks can delay closing, and how prepaids and escrow accounts ensure that taxes and insurance are paid on time. You explored the role of title insurance and ALTA, understanding that owners and lenders' policies protect both buyer and lender from covered title defects. You examined common closing costs, including commissions, escrow fees, association fees, and various service charges, and recognized that the settlement statement is the roadmap that shows who pays what. Beyond residential lending, you studied a variety of commercial financing tools: credit lines, short-term and asset-based loans, bridge and blanket loans, contract financing, factoring, term loans, equipment and real estate loans, leasing, balloon structures, and adjustable rate loans. You connected these tools to the different types of commercial real estate properties they finance. You also learned what SBA loans are, how basis points measure small changes in rates, and how business-level debt ratios and debt service coverage ratios help lenders assess whether a company can support additional loans. Finally, you looked at more advanced concepts like yield maintenance prepayment penalties, which protect lenders' expected returns on long-term loans, and personal guarantees, which extend a creditor's reach to the personal assets of business owners. All of these elements combine to shape how loans are structured, priced, and managed before, during, and after the closing of a real estate transaction. Discussion. Question 1. Why is it important for a buyer to understand the difference between closing from the lender's point of view and closing from the agent's point of view? Answer: because the lender considers the loan closed when it has funded the money through escrow, while the agent and parties consider the transaction closed when the deed is recorded and ownership transfers. A buyer who understands this distinction knows that signing documents alone is not the final step, and that keys and possession typically follow only after recording is confirmed. Question 2. How do prepaids and escrow accounts protect both the borrower and the lender after closing? Answer: prepaids fund future expenses, such as taxes and insurance upfront, and place them into an escrow account. The lender then uses these funds to pay the bills when due. This arrangement reduces the risk that a borrower will fall behind on taxes or insurance, which could threaten the property or the lender's collateral. For the borrower, it simplifies budgeting and helps ensure that critical obligations are met on time. Question 3. Why might a lender require both strong business financials and a personal guarantee from a business owner seeking a commercial real estate loan? Answer: because the lender wants multiple layers of security. Business financials show whether the company itself can support the loan, while a personal guarantee gives the lender direct recourse against the owner's personal assets if the business fails. This combination can make the loan more secure and may allow the lender to offer better terms. But it also means the owner is personally exposed to the risk of default. Question 4. How can understanding basis points help a real estate professional better interpret changes in mortgage rates and their impact on clients? Answer: knowing that 1 basis point equals 1/100% allows an agent to translate market commentary into practical effects. If rates rise by 25 basis points, the agent knows this means 0.25% increase, which may change a borrower's monthly payment or qualifying amount. This understanding helps the agent explain why small-sounding changes in rates can have real consequences, especially on large loans. Closing remarks. Closing a loan and closing a transaction are the moments when all of the planning, underwriting, negotiation, and documentation become reality. Money moves, deeds are recorded, and ownership changes hands. Yet the numbers behind that moment are shaped by a wide range of financial tools and concepts, from simple escrow accounts and title policies to complex commercial loan structures, SBA guarantees, basis point shifts, and prepayment penalties. As you deepen your knowledge of these topics, you become more than someone who fills in blanks on a purchase contract. You become a guide who can help residential buyers, investors, and business owners navigate the financial landscape that lies between "we want this property" and "we own it